In recent headlines, there's been a lot of talk about Michael Burry repositioning his portfolio for a significant market crash in 2024. But are these claims accurate, or is there more to the story? Michael Burry, a wealthy individual known for his astute investments and a track record that includes some remarkable predictions. He gained fame in 2008 for predicting the housing market crash and profiting from it. However, his financial success extends beyond that period. In 2000, he established his own fund, Cyan Capital, to manage his personal wealth. But is he truly infallible in his predictions? Well, Michael Burry's 2008 prediction was spot on. It's crucial to remember that not all of his predictions have been equally accurate. For instance, he also anticipated the dot-com bubble burst, which resulted in falling stock prices. However, it's essential to scrutinize his overall track record, as relying solely on his statements might not provide the full picture. Now, let's address the sensational headlines that claim Michael Burry has bet over $1.6 billion on a Wall Street crash. Contrary to these headlines, a more nuanced perspective is necessary to understand his actions accurately. It's easy to jump to conclusions, but let's dig deeper into the reasons behind his latest moves. To comprehend Michael Burry's investment strategy, we need to look beyond the headlines. His choices are likely influenced by various factors, such as market trends, economic indicators, and potential risks. It's essential to recognize that investing isn't a one-size-fits-all approach, and his actions are shaped by his unique perspective. While Michael Burry's reputation as an investor is well established, it's essential not to take his statements at face value. Predicting market collapses is a complex endeavor, and his actions should be considered within the broader context of his investment strategy. The Big Short is where Michael Burry's story gained significant public attention. In the film, he's portrayed by Christian Bale, and it's a testament to the intrigue surrounding his financial career. But how do we know what he's buying and selling? Well, because he manages such a substantial amount of money through Cyan Capital, he's required to file documents with the Securities and Exchange Commission. These documents are known as 13F filings. However, it's important to note that 13F filings have some limitations. They are filed quarterly, which means they're backward-looking and must be submitted within 45 days of the end of each calendar quarter. Additionally, they don't reveal everything about his portfolio. 13F filings primarily cover listed stocks, American depository receipts, ETFs, and some derivatives. Non-US listings, cash positions, or straight short positions are examples of what we won't see in these filings. So while they provide insight into his activities, they offer an incomplete picture. Let's say the NASDAQ tracker QQQ is trading at about $330. If you believe the price of that index will go up, you can simply buy the ETF for $331. But how can you make money if you believe it's going to go down? In that case, you can consider something called buying a put option. A put option gives you the right to sell QQQ at a price of your choosing. Typically, people choose a strike price below the current market price, often around 20% lower. For example, if you choose to sell at $265 and the NASDAQ falls below that, say to $250, you can buy QQQ at $250 and sell it to someone for $265, resulting in a $15 profit. Essentially, put options allow you to make money when the market goes below the strike price. This is a strategy that Michael Burry has utilized effectively in the past. It allows him to profit during market downturns. He used put options to make substantial gains in the falling markets of 2000 and 2008. Now let's look at his recent portfolio. If we track the total value of his positions quarter by quarter, we notice a significant increase in Q2 of 2023, dominated by two massive positions. These positions are primarily put options, one on QQQ and another on the S&P 500 tracker, SPY. Each put option represents the right to sell 100 shares of the underlying asset. With around 20,000 put options, it appears as if he holds a massive number of shares, leading to headlines claiming a $1.6 billion bet. However, the actual value of these options is much less than the notional $1.6 billion. Due to the leverage inherent in options trading, he likely paid a relatively small amount up front, estimated to be around $30 million for these positions. The precise numbers are hard to determine because the 13F filings don't provide the strike prices or expiry dates of the options. These details significantly affect the cost of the options. To trade stocks like those in Michael Burry's portfolio, particularly US stocks, platforms like Trading 212 are valuable. Trading 212 is known for its low fees and innovative features, allowing you to trade various international stocks directly. Now let's get back to Michael Burry's portfolio. Despite some of his tweets and predictions, when we analyze the sector composition of his portfolio, we find an interesting mix. The dominant sector is consumer discretionary, which includes luxury goods and cars. While this may seem bearish, it's essential to note that consumer discretionary stocks thrive when the economy is doing well, indicating a degree of bullishness. Michael Burry also took a position in Japanese stocks through ETFs, suggesting a positive outlook on Japan's domestic economy. However, not all of his moves have paid off. Some stocks, like Curate and iHeartMedia, have struggled. Michael Burry's investment strategy is characterized by its multifaceted nature, incorporating various elements that distinguish him as a unique investor. Is his use of put options. Put options grant him the right to sell assets at predetermined prices, allowing him to profit when prices decline. This strategy has been particularly effective during market downturns, as demonstrated by his successful predictions during the dot-com bubble in 2000 and the 2008 financial crisis. It's this strategic use of options that has contributed significantly to his reputation as a shrewd investor. Despite his reputation for predicting market crashes, Burry's portfolio exhibits a more nuanced approach to sector diversification. While one might expect a predominantly bearish portfolio given his warnings, he maintains significant exposure to sectors such as consumer discretionary. This sector includes luxury goods and cars, implying that he sees potential for economic growth or at least a positive outlook in certain areas. Furthermore, his portfolio includes positions in sectors like energy, healthcare, industrials, and telecom stocks, indicating a diversified approach to managing risk and seeking returns. Another noteworthy aspect of Burry's investment strategy is his allocation across both domestic and international markets. His portfolio is not confined to the US market alone. He has ventured into Japanese stocks through exchange-traded funds, suggesting that he anticipates opportunities in Japan's domestic economy, which can be interpreted as a bullish stance on that region. Additionally, his previous holdings in Chinese stocks, such as JD.com and Alibaba, indicate his willingness to invest internationally. This diversified geographic exposure not only helps spread risk, but also enables him to potentially capture gains from different markets. However, it's important to emphasize that while media headlines often portray Burry's positions as massive bets, the actual value of these options is considerably less than the notional values reported. Consequently, the figures reported in the media tend to be sensationalized and do not reflect the true financial commitment of these positions. Now let's take a closer look at Michael Burry's track record when it comes to his predictions. In 2017, he warned of a global financial meltdown that didn't materialize. In 2019, he mentioned a bubble in index ETFs, but he's been buying them in Japan. In 2020, he revealed massive bearish bets, only to witness a significant market rally. In 2021, he predicted a market bubble crash in 2023 and a massive recession, but his Q2 filing shows positions that aren't very bullish at all. It's important to note that following all of his bearish warnings over the years would have resulted in missing out on a massive rally in the United States over the last decade. Perhaps you'd be considering moving to China because some of his predictions might have been more accurate there. For instance, during the big crash in 2020, Chinese markets were down approximately 42%. The key takeaway here is to separate what Michael Burry says from what he does. This nuanced approach is often missed in sensational headlines. In the grand scheme of things, it's essential not to try to replicate the moves of billionaires like Michael Burry or Warren Buffett. What they do with their portfolios may not be suitable for your financial situation. For most people, a simple strategy of investing in index funds, holding them for the long term, and not obsessing over market timing is often the wisest approach. If you have found this video insightful, don't forget to show your support by liking the video and subscribing to our channel. Also, feel free to share your thoughts in the comment section below.